You probably know what your investment fees are. Most people do, because the financial industry has spent 20 years making sure that we pay attention to them. But here is the question almost no one is asking. Exactly how much are taxes taking from your portfolio every single year? A Columbia finance professor just ran 100 years of stock market data through the actual U.S. tax code year by year to find out. And today, Mark and I are going to talk about what this means for your retirement portfolio.
It's easy to get lost on the way to retirement. Things like taxes, improper planning, and excessive market risk can all lead you astray from your goal of a successful and happy retirement. That's where Liz Whittaberry comes in. She's a holistic financial advisor and the founder of Best Path Advisors, and she can help guide you to a better financial path. This is Retire on Your Best Path with Liz Whittaberry.
Welcome to another edition of Retire on Your Best Path with Liz Whittaberry, founder and financial advisor at Best Path Advisors. Find her online at bestpathadvisors.com. That's bestpathadvisors.com to have a consultation and a conversation about your retirement journey and maybe about today's topic, which is, are you kind of won on fees? Are you losing on taxes? And, Liz, what caught your eye first on this topic?
I'd like to read Jason Zweig's articles in the Wall Street Journal. I think he has a really good way of stating things. Okay. And his headline, "You won the battle on investment fees, you're losing the war against taxes," caught my eye because I'm very focused on tax planning. That's why I'm working on a master's in taxation right now.
Right.
Just finished that tax planning certified professional program through the American College. But in that article, he referenced a brand new research paper. So I went, found the paper, read it, and it's very interesting.
And this was by Andrew Ng. And so why did his research matter to the article Jason was doing?
It was very interesting because Andrew Ng is a former Columbia finance professor, former BlackRock researcher, has written a lot of articles. He does serious academic work, and this was also serious academic work. He built a simulation to apply the actual tax rates that were in force every year from 1926 through 2025, assuming that there was a model investor holding the entire U.S. stock market, to say, how much is taxes costing in real life? How much would it really have cost? In the most recent period, and he divided it into 30-year periods, which is something that people doing research like to do when they're looking at the market. But he divided it into 30-year periods. So in this most recent 30-year period, 1996 through 2025, he showed that the market returned 9.91% a year before taxes. But after you account for the federal income tax, not state taxes, just federal income tax, it cost 1.65%.
So you kept that versus what it cost, correct?
Yeah, you kept 8.26%.
Gotcha.
And that's a pretty big cost.
Yeah, it's like 165 basis points kind of a drag. Yeah,
that's a lot. So, for those that don't know, basis points, that's like 1.65%. 165 basis points is 1.65%. But, if you started with 475,000 30 years ago, this is what he showed, after tax, it would have grown to 5.1 million. If there were no tax, it would have grown to 8.1 million.
Oh, wow. Okay. $3 million.
Yeah. I mean, the 5.1 million is a good number.
Yeah.
We want to take 475,000 and grow it to 5.1 million. But when you think about taxes would have cost 3 more million that you could have had, that's about 36% of what it could have grown to. That's pretty hefty.
Wow. That is interesting. So that 165 basis points is, I guess in some ways it's good news, right? It's the best tax environment in the last 100 years to a point that they made. But again, you got to take this into account because there's also this kind of overarching historical picture of this data as well.
Yeah, when we look at the whole 100-year period, and he was able to divide that into 8 overlapping 30-year windows, he showed that the average of all of those periods was 347 basis points. So almost 3.5% cost.
Yeah.
Which is more than double that tax drag that we currently have. We're in a very good tax environment right now.
We've talked about that many times, right? We're in historically low tax environments, even when we don't feel like it, but it actually is, right?
Right. And so we have to be careful what we complain for, because it could be a lot worse.
That's a good point.
The worst was 538 basis points, so over 5%. And that was from 1936 to 1965. And he shows that the reason for this was how dividends were taxed previously versus how they're taxed now.
Sure. And World War II, right? So obviously the tax rates, many people don't even realize that we're at 90%, right? You could get hit with stuff. And so that made an impact, I'm sure.
Yeah, that 90%, because dividends were taxed as ordinary income, not at capital gains rates. But that 90% tax on dividends was very hefty.
Sure.
And capital gains in that period of time. So if you're rebalancing, capital gains were 45%. Today, qualified dividends are taxed at capital gains rates, and those top out at 20%. And then you have that extra 3.8% net investment tax that gets added on. But we can see that the tax drag is so much lower today because we have the lower rates, and then companies are also paying out less in dividends and doing more buybacks and other things that are also a little bit of a different tax impact for the investor.
Yeah, that's a great point as well about the dividends, about them paying out less, right? So we saw a lot of that with big companies through the years, GE and whatnot. So the research showed that as much as, 5.38%, as you mentioned before, of the annual return was eaten up by taxes. What are the drivers of the tax cost?
Yeah, the paper shows there's really two things. The dividend taxation, and that is lower now, and maybe it'll stay lower, maybe it won't. Tax law can always change. And then the capital gains that were realized when portfolios were rebalanced. The bigger piece in the past was the dividends, and that's why it was over 5% average in one time period, because that dividend being taxed at ordinary income tax rates, which got very high after World War II, that really drove the tax, that tax cost up.
So, Liz, what if tax rates do rise? We just talked about the fact that we are in these low environments. What happens if it goes the other way?
Yeah, and I think this is the most important thing in the paper for people who are planning for a retirement for 20 or 30 years. Looking ahead, what will taxes be over that period of time? We're currently in the best tax environment for investors in the last 100 years, but that's not permanent. And tax rates have generally declined over the past century, but the paper points out that many analysts expect rates are going to need to go up because of the trajectory of U.S. fiscal health, our GDP to debt ratio. So there's a lot of things that people need to be thinking about to take advantage of this environment.
Yeah, so clearly the 1.65 or the 165 basis points, 1.65% could certainly be a lot worse.
It could be a lot worse. When Eng ran a counterfactual and applied the 1944 wartime tax code to this modern 30-year period, the cumulative taxes were multiples of what investors actually paid. And so that is something to keep in mind going forward. We could have high inflation. We could have stagflation. We could have, taxable gains on money that is a nominal gain. There are things that happened in that time period that could happen again. People need to be aware of that, need to be thinking ahead. What can I do to put myself in the best position going forward?
Yeah, I mean, obviously that's the point. A lot of the things we cover and talk about, right? What does it mean for somebody actually planning for retirement today?
Yeah, that is something that we talk about a lot because that's such an important point in all the planning I do. Your planning assumptions have got to be stress tests for tax rates. You need to think about what happens to my portfolio if tax rates are going to be higher. So if you're building a 23-year retirement plan and you're assuming that the current 20% qualified dividend plus 3.8% net investment tax, that's going to be the thing that holds over the entire period, that might be optimistic. The range of potential outcomes in the future could be much wider than your plan is acknowledging or giving you. And so you want to make sure that you've stress tested that so that if taxes are higher or if it shifts so that dividends and capital gains are taxed a little bit differently, then how does that impact my retirement 15 years in, 20 years in? This is important to plan ahead for so that you're prepared. And let's hope, the best happens and we don't get the taxes that we had in the past. But You want to be ready for it.
But let's be honest about that, right? I mean, the current tax code that got extended will expire in 28, so going into 29, right? So there's a chance something, we'll have an election. Who knows if that changes? And we're 38 plus trillion, closing in on 40 trillion, right? So the chances of taxes still going up are, still loom pretty large.
The debt to GDP ratio is slightly over 100% right now, and that's the highest that it's been since World War II. So we just have to keep in mind, and we've got Social Security issues coming up. There's a lot of reasons that taxes may go up.
Yeah, great point. Okay. Well, they also talked about, back in the article here, Liz, the paper had some interesting findings about ETFs specifically. Can you break that down for us a little bit?
Yeah, and that was one of my favorite parts, because I do talk to people a lot about ETFs versus mutual funds, and people will have mutual funds that they've had for a very long time in their portfolio and don't really understand the difference. ETFs have a structural tax advantage over mutual funds and even over directly holding the same stocks, which was interesting. And that comes from something that is called in-kind creation and redemption. So the mutual fund is, they're buying in kind. And so when maybe institutional investors are selling out of the mutual fund or other investors are selling out, it's not impacting you as it would in a mutual fund. You're only getting impacted by what you yourself do.
So the gains that we would get then, they get deferred?
They do get deferred.
Okay.
They don't disappear, but they do get deferred until you sell your ETF shares.
Gotcha.
And that deferral has some real value. And this was the interesting thing. In the 1996 to 2025 period, that is our low tax period, the ETF structure earned about 49 basis points, so almost 0.5% more per year than directly holding the same stocks. And that's because things that happen relative to maybe the company is doing some buybacks, or there are things that happen that get deferred that wouldn't get deferred if you're holding it directly. And so you actually have a little bit of an advantage by holding an ETF. And that I did not know.
That's interesting.
I knew that ETFs were much more tax advantaged than a mutual fund, but that part I didn't know, and that I found interesting.
So having, let's say, stock in X versus an ETF that holds stock in X, for example, like XYZ, whatever company, right, tended to do better in the ETF. That is interesting. Yeah, I wouldn't have expected that either. How does that tax benefit compare then, Liz, to what most people focus on, which, like with the ETF expense ratio, for example?
That is the striking thing in the analysis. The paper noted that broad market ETFs might charge 2 or 3 basis points in annual fees. So we have some very low cost ETFs that track the S&P 500 or the Dow Jones Industrial Average or other big indexes. And that is good, that is low fees, but the tax advantage of that ETF structure is 10 to 20 times larger than the fee advantage. The reason to own the broad market ETF is not primarily because of the low cost, it's because of the tax structure. And that's where mutual funds really fall short. Most mutual funds carry fees that are anywhere from 5 to 20 times higher than an ETF. But the bigger problem is the tax consequence of holding the mutual fund. When things happen inside the mutual fund, when there are capital gain distributions, or somebody is liquidating and the mutual fund is needing to raise cash, that gets passed through to all shareholders that own, whether or not you took any action.
Yeah, it's a collective pool.
Fund.
Yeah, it's a collective pool, right? So you're paying taxes on somebody else's decision.
Yeah, exactly.
Sell, right? Yeah.
Exactly. And so the ETF structure eliminates that problem because of that in-kind redemption mechanism. And that is really one of the most underappreciated advantages of the ETF.
Okay.
And something that I try to explain to people, because it's just like a fund is a fund and they have similar names. And so I don't understand the difference, but the tax difference is big.
Well, mutual funds have been around forever, right? ETFs obviously have been around for a while now, but obviously the advent in technology allowed for that to work faster. We've talked about the differences between those before. Obviously ETFs, they trade more like a stock, right? Versus waiting to the end of the day, like a mutual fund and all those things. So certainly a game changer there as well. So talk to us about the step up in basis. You mentioned that deferred gains are not tax free. They're just tax postponed. We talked about that kind of in the beginning of this topic. Is there a scenario where they actually do disappear, though?
Yeah, and that is very powerful. And we've talked about it before. It's called the step up in basis at death. And the simple
Right, right.
version is that when you pass away, your heirs inherit your investments at whatever they're worth, and your cost basis is that same value. So if you have gains, you've held something for a very long time and it has grown, and you've got this large gain in that stock or that ETF, that basically goes away because your heirs now have a cost basis equal to the fair market value that they inherited at. They can turn right around and sell it, and there's no tax to pay. The IRS doesn't get any tax on that gain. It basically is forgiven. It goes away.
But if you never sell, those gains could disappear then?
Yeah. If you are holding your shares and you don't sell them, because
Mm-hmm.
you can't get a step up in basis, but
Right.
you don't sell them because you don't need to use that particular piece of your portfolio. It's something that you have targeted to go to your heirs. Then when they inherit it, then yes, it goes away. And the thing that was interesting is that the paper says that if you're about 55, 56 as a man
Mm-hmm.
or 59 to 60 as a woman, at that age, the odds flip and it becomes a much higher probability that you're not going to use the funds. You're going to get the step up in basis. And that makes a big difference in the actual tax cost.
Gotcha. So what does that mean? Let's say if you're 65, Liz, and sitting on a taxable account with a lot of built up gains.
So at that age, this becomes a very important planning topic. There is a strong argument to look at that closely and not sell the positions if you can avoid it, if you don't need to use it, because every year that you hold on to it, it's more likely that your heirs get that step up in basis and that tax cost goes away. And the paper showed that at age 70, if you factor in the step up probability, that the tax drag drops from that 165 basis points down to about 103 basis points.
Nice.
So that's a pretty significant reduction in tax costs because those capital gains never get paid.
Yeah, so 1% versus 1.5, 1.6, right? So
Yeah.
what about somebody who's younger and still accumulating then?
Yeah, for people that are under 50, it's not really a factor yet. The expected benefit, the paper said, is far enough in the future that it's not really meaningful. It doesn't change the math today. So anyone under age 60, they shouldn't be focused on that as their main planning thing. But once you get in your 60s and 70s, it becomes a real planning topic to think about and something that I look at with my clients to determine what is the best place to take money, not just for your own tax costs, but also for your heirs
Yeah, that makes
and
a
their
lot,
tax cost.
makes a lot of sense. Well, so let's talk a little bit about some solutions here, Liz. So what does the research say? The paper offers anything, good besides the ETF? Obviously, that was a bonus. Anything else to think about?
Yeah, so one thing that is often talked about is tax loss harvesting. And I do use tax loss harvesting because it certainly helps with the current tax cost. But the paper says there's a very realistic ceiling on that. It is maybe about 30 basis points a year in savings. So you can't really count on that to make a big difference. It's also dependent upon the market cycles. You may not have losses in your portfolio, especially the longer you hold, even though the market might be going up and down, it's not coming down enough that you end up with a loss. So tax loss harvesting doesn't become something that people can really count on. So the bigger lever is asset allocation.
Oh, gotcha. Because basically, it's tax loss harvesting important, but it's not a silver bullet, right?
Right.
So you need more of a
Exactly.
real solution. So what's some things to think about?
The bigger lever is asset location, which means where do you hold investments? Which account are you going to own NVIDIA in? Or are you going to own a municipal bond or a corporate bond? Which account are you going to own these various different things in? Holding equities in your Roth or your traditional retirement account is going to eliminate the capital gain on that. And if it's something that's going to grow a lot, then putting that in the Roth is going to shield all of that growth, not only for you, but for your heirs.
Gotcha. Okay. Well, let's wrap it up this week, Liz, with some action steps for the listeners to think about, right? So what's some kind of summarize the conversation in some action points?
Well, the first thing I want to say is that you always need to be doing tax planning, not just filing your taxes, but doing tax planning so that you're thinking ahead as to the things that you can do over time, because planning is about what happens in the future.
Mm-hmm.
And each year that you do planning, you're building on the foundation to improve what happens in the future. This is going to really hit people that have taxable accounts. So you want to think about, what is in your taxable account? What embedded gain do you have? What tax liability are you setting on? What do you own in different accounts? Talk to your advisor about where do you own the different investments that you own. Make sure that you're shifting that to get the lowest tax cost currently, the best step up in gain for your heirs. And another really important one is don't assume that tax law that is currently in place is going to be permanent.
Right. When they say it's permanent, it's not permanent.
Yeah. It's permanent until
until another administration, or whatever.
Exactly.
Yeah.
They change their mind. And even the current administration sometimes can change its mind,
That's true. And I think that falls too, Liz, to the we're going to be in a lower tax bracket when we retire myth, if you will, right? That same kind of thing applies. We often hear that, but many times people are not. They're in the same tax bracket. So just be aware of those.
And you may actually end up in a higher tax bracket if they change law.
True. Yep. Okay.
And when a lot of those sayings were put in place, it was back in the time period, the 70s, that tax rates did get to 90% if you were working. And so people were counting on deferring to the future and being in a lower tax bracket in the future. We are not in that time anymore.
Good
and
point.
So we've got to start focusing on what is really appropriate for this time and what could be happening in the future based on what we're facing. If you're approaching retirement or in the early gap years of retirement, don't waste those years. Make sure you make the best use of them so that when you hit required minimum distribution age, you're in the best position possible, because the tax drag on your portfolio, that's real, it's large, but unlike market returns, it is something that you can actually do something about. You can have some influence over what happens there.
Yeah, there you go, right? As going with the old sayings, it's not what you make, it's what you keep. And, tax buckets, just the same as income bucket strategy, tax bucket strategy, whatever terms you want to go with, you can be a bit more tax efficient and really, make a real difference, to your point, make a real influence on that. So, Liz, we'll put links to the articles and everything that you researched here and are talking about in the show notes if folks want to go check that out for themselves. Make that easy. And of course, as always, if they want to reach out to you and have a conversation, make sure that they are on their best path towards retirement, especially when it comes to taxation, right?
Yeah.
Then get some time on the calendar. bestpathadvisors.com. That's bestpathadvisors.com. Any final thoughts, Liz, before we go?
What you said is so key. It's not what you make, it's what you keep, and that's what you want to focus on.
Yeah, and you got to have a strategy to do it, right? So just winging it does not work in today's day and age, for sure. Certainly, we're learning that every day. So again, if you need help, reach out to Liz, who is the founder and financial advisor at Best Path Advisors, as I said a second ago. Find her online at bestpathadvisors.com. That's bestpathadvisors.com to have a consultation and a conversation for yourself. And don't forget to check out all her tools, tips, and resources on her website as well. Liz, thanks for breaking this down. This was a great conversation this week, as we usually do, but a lot of good information, a lot of information to digest as well. So again, if you need some help with it, check out the articles for yourself or just reach out to Liz and start that consultation. And we'll see you next time here on Retire on Your Best Path with Liz Whittaker.
The preceding program is sponsored by Best Path Advisors, which is solely responsible for its content. Securities offered through J.W. Cole Financial, member FINRA SIPC. Investment advice offered through J.W. Cole Advisors. Best Path Advisors, J.W. Cole Financial, and J.W. Cole Advisors are unaffiliated entities. The opinions expressed by Liz Whittaker should not be construed as specific tax, legal, or investment advice, nor as an offer to buy or sell any securities mentioned herein. Neither J.W. Cole Financial nor its representatives provide legal, tax, or accounting advice. Persons who provide such advice do so in a capacity other than as a registered representative of J.W. Cole. Investing is subject to risks, including the loss of principal. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable, however, their accuracy or completeness cannot be guaranteed.